Hey, good morning, everybody. Welcome to the Ankerstar Wealth Morning Update. Mike and Steve here. We got three topics for you today. First of all, what's going on in the markets? What's this color I'm seeing? It starts with R, rhymes with dead. I mean, I don't like it at all, but yes, it is all part of the ups and downs of the market. But today, the market's off a little bit. Why, you ask? Well, let's talk about our first couple of topics that Mike's going to cover. Is we had Google earnings, and then we also had Tesla earnings. So Mike's intimately familiar with both of those. He's going to share his wisdom here in a second. And then if you have an inherited IRA, you want to listen to the end because some of the rules just got clarified by the IRS. I'm going to summarize those and we can go from there. Before we get started, this is a financial education presentation. You have to do your own due diligence before acting upon anything you hear in this presentation. More disclaimer information is available at ankerstarwealth.com, and the opinions expressed are Mike and mine alone. So Mike, over to you.
Yes. Unfortunately, we are seeing red. So I'm sharing my screen. You can see the red across the board, and especially that it would be a darker red if you could do it in the NASDAQ, down 2.6%, S&P down 1.68%. You know, those are big drops. It's not necessarily sector rotation, which we saw last week, but what's driving it? At least Google, certainly Alphabet, is one of the biggest companies in the world, and Tesla's pretty big, as far as market cap. Both of them came out with earnings. The earnings themselves or even the revenue, not, incredibly bad. It's not like they had major misses, but some of the things they shared within those earnings calls is what's driving it red. And that's what I'm going to show. So I'm going to talk a little bit about that. So with Google, the biggest thing they came out is, hey, AI is going to cost more money. Wow, there's a shocker. They're investing in AI. Good thing. That's a good thing to do. We're going to have to hire more college graduates. Expenses. There's less, revenue or less profit. These are things that concern the overall shareholders. And this is kind of why this was driven down. You can see the stock. I'm going to bring this up, and you can see this is a 3-month graph that I'm showing. But you can see that in 3 months, you'd call it flat at this point, but it did touch 190. So in the last couple of weeks, it has sold off. So, is Google still a great company? Absolutely. Did this fundamentally change our thesis? Absolutely not. This company is going to be around, and we're going to see a lot of this with these AI plays, going forward. I found the Tesla one to be a little more interesting because I dove into this to understand why Tesla dropped so much. So, revenue, they actually beat by a little bit. As earnings per share, they missed by a little bit, but not 10% plus as much of a miss. And that's what the stock is down, over 10%. So why is that? And in the articles I read is that they are looking to expand more into affordable automobiles. Now, as a consumer, you're listening, you're like, affordable automobiles, I like that. That's a great place to be. As an owner and as a former automotive employee, I think affordable means less profitable. And as the owner, that's kind of the way we need to think about it. And we don't have Teslas in our models, but if you are holding Tesla stock, you're going, why is it down 10%? Because they're trying to get into less expensive, cheaper autos. And that's where Tesla, I would say, should not be. They shouldn't be going into it. Yes, it'd be great if every single person drove a Tesla for their company. But when you start going less profit, less expensive, you get less profit. And that's what we're seeing. But I want to show something real quick that helps you understand also why Tesla's selling off. I'm gonna highlight. This is the Ford graph, but what I want to highlight is the market cap for Ford is 55 billion. And I'm going to show you the market cap for General Motors is $52 billion. That's what this company is considered to be worth. And the market cap for Toyota is 313 billion. Sorry, GM and Ford. Toyota's worth 6 times as much as you. So those 3 companies are worth over $400 billion. But here's the key one. Tesla, market cap $700 billion. So right now, the market values Tesla more than GM, Ford, and Toyota combined. And, that doesn't sound right. Now, if Tesla is a software company, if they're going to be building flying cars that can, GPS and land where they need to be, there's certainly some huge upside to it. And that's certainly where they're going to talk about doing things. But if they're a car company, if they're in the car business, they can't be worth this much more than every other car company. So what needs to happen for Tesla to go up? Either the other car companies go up in value and they stay ahead of them, or Tesla comes out and they're really not a car company. And that's what Elon Musk would tell you that they're not. So what I'm showing on this graph is Tesla's 5-year graph. So if 5 years ago you bought Tesla, yeah, you'd have doubled your money. Great. But if you look at really the last 4 years, it's flat. I mean, yes, there's spikes. It goes up, it goes down. But if you bought this stock at the beginning of 2021, almost 4 years ago, you're break even. And maybe you're good with being break even because it has been down, or maybe you're not good with break even because it has been up. But this is the thesis behind it, that it's not a or it's not a car company, it's a software company, and that it should be valued like that. So it's kind of sitting in between. It's a very interesting stock. It's a great product. It's a great company. It's just, it seems overvalued. And that's part of the reason we don't hold it in our model. So anyways, I'll turn it back to you, Steve. And it's down 10% today. So, yay. If you loved Tesla 2 days ago and you were like, I'm thinking about buying their stock, well, guess what? It's on sale, 10% off today. So you can buy it. But
and leave that chart up there for a second, Mike. So really, all those numbers you threw out, if it's a car company, right, which I think it is, yeah, the stock's like worth like 20 to 30 bucks. Right. So, I mean, that's literally what you're looking at if the flying taxis and all the other stuff that are out there don't pan out. So anyhow, my stance on Tesla, so I will say no more. Of course, I will say some more. Mike, you could go and bring that down because I will transition with the segue I did not know I had in me. But since we're going to talk about something super interesting, here, I will show you. Can you see this crazy page 6 thing, Mike?
Not yet.
Yeah, I didn't think it shared out. Something didn't work here. There it is. Okay, yep. Since we're talking Elon Musk and we're talking inherited IRAs, he isn't married. He's got 12 kids. And the article, this is page 6, so take that for what it's worth. It's like, I like this line: the Tesla mogul has at least 12 children. So anyhow, 12 acknowledged, probably, who knows after that. But that's not what I'm talking about. But what happens when you pass away, right? Because it's going to happen at some point in time, or, one of your parents or your spouse. So remember, the situation is if it's a married couple, which is kind of where we start with, is if one of them passes away, the IRA simply transfers to the other person. There is an option there that I've seen this happen once where somebody got burned because they didn't talk to a financial advisor first, but where if you are younger than 59 and a half and you have a spouse that passes away, if you use the normal rule where it simply becomes your IRA, you can't touch that money without taking a penalty, because you're under 59 and a half. And I've seen somebody get burned by that. So especially if you're super young, if you're like in your 40s and, tragic accident, right? Generally at that stage in life, then you don't want to take it simply to your IRA if you need the cash flow. What you want to do at that point is you are allowed, even as a spouse, to take it and codify it as an inherited IRA, which throws it under different rules. And in that case, you can take it out. You just don't, you pay taxes on whatever you take out, but you don't pay the penalty. So anyhow, if you have a tragedy like that happen in your life, talk to some financial advisor out there, at least before you start making decisions, because you're going to make a lot of decisions real quick in an emotional state, or excuse me, where you're probably not at the top of your game. So, so now that's the spouse situation. But what we're talking about right now is if it's, the second to pass of a couple, and now you're talking beneficiaries that are 10 years younger, generally children is kind of the standard situation there. Then you have, the rules have changed. Before, it's Secure Act 1.0, which is 2019, changed the rule, which was enacted in 2020. If somebody passed away before 2020, basically the rule was you, the beneficiary, had to take out required minimum distributions over your lifetime based on your own age, right? And everybody could kind of understand that. The problem the problem for the government is people were passing away and giving, beneficiaries, and then not being able to get the tax revenue off of all that money that's now being passed down because they could kick it out over a lifetime. So the ultimate example is you are 99 years old and you have $1 million Roth IRA. And now you pass away and you're allowed to give it to any living person. So you give it to a 1-year-old. Well, that 1-year-old could now, over their lifetime, basically delay taking out that money anyway. And of course, there's no taxes. And that's a bad example for taxes. But, it allowed the growth now for basically another 100 years. So they stopped all of that, right? So now it's 10 years, you have to draw the money out. Obviously, if it's Roth, you don't owe taxes there, but you do have to deplete it over a 10-year period. If it's a tax situation, which is this article is talking about, you might want to manage that 10-year window. Obviously, if you wait until the end of the window, which used to be legal, this rule just changed. You could just had to take it with anywhere in the 10 years. You could wait till 10 years and then just pay a lump sum tax when you deplete it. Now, with the new clarification from the IRS, that you have required withdrawals, which is what this is talking about. So somebody passes away in 2020, you used to be able to manage it out to 2010, how you're taking that money. We've had a 4-year pass of clarification on the rules where you haven't had to take any money. But starting, I think, in 2025 is when this is enacted. Then now you have to start taking an annual RMD in that account. So it's not, you can't just leave it lump sum until the end. So, and again, this is something that they clarified 4 years later after they enacted the regulation. So a little bit confusing. Do take that into consideration. The article here is from Ed Slott, who is kind of notorious / famous in the industry with advisors for giving tax advice. There's the idea of you don't want to pay taxes now, you want to kick it all to the end. Well, don't forget the accounts grow. So even if you inherited, say, $100,000 in, say 2020, and you have till 2030. Well, a lot of people are like, well, I'll just take equal amounts out. So that 100,000, right, divided by 10 is 10,000. So that first year they take out 10,000. Well, guess what? If the account's up more than 10%, you haven't taken out anything. All you've backed out is less than the gains, right? So the account can continue to grow. So if you were really to try to streamline what you want to take out, you want to take out the gains for that year, plus then another additional 10% of the original balance. That would be able to keep it more of a straight line for your tax purposes. Otherwise, it's going to balloon on you. The only time where I would say if we're talking normal ages, right, of people passing away in their 80s, early 90s, the people inheriting the IRAs are at that 50 to 60 point. You may be where you're looking at retiring, so where your own income drops. That would be the only case where I would take the minimums that's now required and let it build up until you actually hit that retirement phase. So your own income is now not considered in the tax bill. So definitely something. This is where, if you're a fan of Excel, we have software that helps us do this. But if you're trying to do this on your own, you got to pull out the Excel program and kind of figure out what this is going to look like and give yourself a headache. And again, that's why advisors have, always are in need and have a business, is because the IRS sets crazy rules like this and clarifies them 4 years later. So, all right, that's all I got. Mike, anything to add on the inherited IRA thing?
Not on the inherited IRA exactly, but I did get some bad news. I checked 23andMe, and Elon Musk is not my father. I was hoping maybe I was going to be inheriting a lot, but Oh, well.
Yeah, well, he would have had to, have you up 2 years after he was born, right? Or 2 years before he was born, something like
I
that.
still had hopes. I had hopes.
But being the quintessential financial advisor you are, I know what you meant to say is, hey, for all of our listeners that are, 20 and below, you should, as part of your, you check unclaimed property once a year with the state you live in. There's certain, you should check your credit report once a year, and you should check 23andMe to see if Elon Musk pops up, right? So, I mean, even though it's already split 12 ways, I still think you're going to be okay if you end up on that list. So, all right, good stuff today. Thanks for clarifying that stuff for what's going on in the market. So we are heavy into tech, so we're seeing some pretty ugly numbers out there. I do say that sometimes it's better to look away and go on about your day. So if that's you, put the phone down, go live life, and we will see you guys back tomorrow. You have a good one. Bye.